Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by returning guest, Fred Moskowitz. So, Fred, how you doing?
Doing great, Dan. Thank you for having me back on the show. It's so exciting to have another great conversation with you today.
Yeah, no, thanks for coming back. So the last one was good. I think it's been like about exactly a year, so it seemed like good timing to come back. And I know you also have a book coming out basically right about now by the time this airs. So I thought we'd check in and kind of see what you've had going on.
Yeah, thanks for asking. Yeah, real excited about this project. It's been a long time in the making, and it's finally coming out this month. The book is called The Little Green Book of Note Investing, and we really take a deep dive into note investing from the perspective of someone that's learning about this amazing asset class, and how to get involved, and whether that is active, as in buying your own notes for your own portfolio, or getting involved as a passive investor by investing in a note fund. I mean, I think that debt investments should be a part of everyone's portfolio. I really like the narrative behind this asset class, and it certainly warrants a good look and a good consideration to see if it's right for you.
Mm-hmm. Yeah, I mean, it's interesting because you look at people's normal retirement portfolios, right? It's like, I work for XYZ company, and they're like, here's your 401k plan. You can choose from these giant mutual funds. There's not really a lot of control, right? If you look at the broader world of investing, there's all these other things out there that you can do. Yeah, debt is a big one that most people don't even really consider. I guess they might have, some bonds as part of a bond fund, but not like what we do in note investing.
Oh, Dan, you bring up such a good point. That really resonates with me. And here's what I see. I mean, I talk to so many investors. I talk to people all the time. And one of the things is I run across people who say, yeah, I'm doing great with my investing. I love it. I have my 401k at work and participate in that. But I just asked them a couple of questions, right? Because this really opens up the conversation. The first question I ask people is, do you actually know how many different 401k and IRA accounts you have and what institutions they are? Right? People move around, mm-hmm. from jobs, and they lose track, or they leave a 401k in an old employer, which I think is a huge mistake. But people end up having these scattered accounts. So that's always the first question is, do you know how many accounts you have and where they are? And the second question I have is, do you know what's your most heavily weighted asset class? And then the third question is, do you even know anyone that works at the company, at the institution, or what their investment thesis is? What's their objective? And so when I ask those questions, that really gets the wheels turning, because people realize, there's a lot more to it than that. It's such a huge mistake to just leave money sitting idle in an account and you're not paying attention, and you're basically falling asleep at the wheel. And it does take work. It takes work to be active with your investing. But when you turn to alternative investment classes, the potential is huge. So I always encourage for people to take a look at that and see if it's right for you and your situation.
Yeah, it's interesting how, I think to your point, like people do move jobs definitely a lot more often than what they used to. And I've had that too, where I've had, IRA accounts or 401k accounts at different employers and then, rolled them over into other plans. And, for me, like I've historically have kind of stopped using it now, but tried to use Quicken to try to keep track of some of that stuff. But it's not really that easy altogether. And it seems like nowadays when a lot of people think of alternative assets, they think of like Bitcoin or something like that, which, has its own merits, but pretty dang volatile compared to some other things.
Yes, absolutely. I mean, for me, I really like the narrative behind alternative investments where there's a tangible asset backing your investment, whether that's real estate or debt that's secured by real estate, something like that. But another point which you brought up earlier was about the diversification, right? How many people do you know where for them, diversification means that, oh, I have my 401k plan at work and there's 6 or so options to choose from, and I spread my contribution out among all those, and that's my diversification. And that's such a fallacy, but unfortunately, that's what Wall Street leads us to believe through all the marketing and all the news headlines, and people get this false sense of security that they're diversified because they split up their investments between the 6 options in the 401k plan. But nothing can be further from the truth, I think.
Yeah, I mean, a lot of people are like, well, I bought some Apple and I bought some Amazon, so I'm diversified now, right? And that was kind of like what originally drew me into notes was when I just wanted to move some of my retirement into real estate because I'd always been heavy in stocks and I had kind of lived through the dot-com boom and bust and the financial crisis. And it's amazing how like overnight those values can, change by 30% plus, and you really have no control over it. You're kind of just along for the ride.
You're just along for the ride and you have no control. Exactly. Isn't it better to have some amount of your investment portfolio, of your retirement accounts, invest in asset classes that are isolated from the market swings, right? That the values don't change. And better yet, that they generate income for you on an ongoing basis. There's nothing better than investing in something where you get paid while you wait. So I always encourage people really to get out there and take note of new opportunities because there's a whole nother world out there. And that's one of the big premises of my book. The theme in the book is take note of new opportunities. Because it requires some work. You do got to put in some work to learn, educate, and further your own knowledge, abilities, and relationships in order to be successful in this business.
Yeah, and I think the timing, as we get deeper into 2021 might be good, right? Because from the performing note side of the house, property values have run up. So there's a lot of equity behind those, and you can still buy them at decent yields, and then on the non-performing side, we may see, the next wave of delinquencies here at some point. So yeah, the timing could be good for that as well.
Yeah. Performing notes are very powerful, right? It gets back to that point of getting paid while you wait. Having a percentage of your investments into income producing debt assets like this, where you're getting paid, you're generating a nice return for yourself, and your investment is backed by a tangible asset. That's really powerful. It's almost like having the foundation of a building, having a rock solid foundation, because that's going to carry you through in tougher times or more volatile times.
Yeah, right? And I like them right now, right? Because you can buy them at yields that are higher than kind of the historical stock market returns. And then you've got equity to kind of protect you so you can recover, if something goes sideways. For the most part, there's still risk. And then you've also kind of got this optionality with them, right? Because you're always buying them at a discount and the borrower may pay off. So it's like you get decent yield with equity protection and then a little bit of upside on top of that. And it's hard to find that. I don't know where else to go get that. I'm sure there's other places you can, but I don't know where to go.
Yeah, that's a great point. It is not easy to find. And with the note fund that I'm involved with, we're seeing a lot of that. We're seeing a lot of notes that are being refinanced out. They're being paid off, whether it's because the property sold or refinancing that's happening, especially in this low interest rate environment. We're seeing a lot of notes where they're being paid off for one reason or another. So a lot of people are taking advantage to refinance, lock in at the lower rates and better financing terms, which really, when you have that happening in a broader portfolio, it really drives up your rate of return, right? Like you said, because of discounts involved when buying notes. When that note pays off, the whole rate of return really spikes up, and that has a massive impact in the overall portfolio.
Mm-hmm. Yeah, for sure. So what are some of the other things that you kind of cover as you go through the little green book?
Well, we do really an end-to-end look at the notes business and how does someone get involved in evaluating notes, right? We talk about the basics and the mechanics of the note documents, like the note, the mortgage, the assignments, all of the mechanics of the physical components of a note file when you buy a mortgage and how that works. But we also get into how to conduct due diligence. And that's from the perspective of analyzing individual notes, or maybe you're considering to invest in a note fund. So how do you do due diligence on a note fund, which is a little bit of a different approach, but just as important.
Extremely important, right? Because it's people have had various experience, like some of the operators I know out there, there are a lot of them like you that are, very rock solid and they have everything together. And then there are some other folks out there that, if you just look them up, you find all sorts of issues. So that's a good point, right? Like doing due diligence on the fund that you're looking at investing in is just so crucial.
It is. It's very crucial. Very crucial. You need to, when you're considering note funds, you need to consider it from this perspective, like the due diligence that you perform on the operator and evaluating them. That's just as important, if not more important, than the asset itself.
Right.
Right. Because you're going to be relying on their expertise and experience in order to manage a very large portfolio and utilize their skills and experience and strategies to be able to add value and make it a lucrative investment for the passive investors. It's so important. I've heard this analogy in the past where when you're evaluating a fund, you really have to think that you're betting on the jockey more than you're betting on the horse. And that's so true. The people involved, they're the people that you're building a relationship with them. You're building a long-term relationship with them. A lot of note funds have a longer-term time horizon. It's like 3 to 5 years. That's what I always tell people, that because there is a cycle here involved. So you need to look at it from the perspective of having a 3 to 5 year time horizon. And if if you like how things went with the note fund, with the particular operators you've invested in, when that note fund winds down and closes, you'll probably be able to join a new one with them and keep that relationship going. I mean, that's something we see with our own investors. I mean, I like to take the perspective of, hey, we're entering into a very long-term relationship, and I'm going to do everything I can to make sure that things go well and that everyone benefits together.
Yeah, because most note fund operators, I was going to say, like, they don't just do like a fund. There's like fund 1 and 2 and 3. And then, yeah, a lot of times their investors are, rolling over from one fund to another over, as you said, like a long period of time versus, some kind of short-term relationship.
Exactly. This is not a transactional relationship by any means. And you have to approach it that way. Absolutely. And in particular, if you're investing using retirement account funds, like from a self-directed IRA, or maybe a self-directed HSA, health savings account, you really have a long-term perspective, because you're not going to be utilizing that money for a long time. So you want to build those relationships up, because what you want with those kind of accounts is you want to keep your capital at work as close to as possible 100% of the time. Mm-hmm. You don't want to have uninvested capital sitting there idle, because that's going to result in a 0% return on that money, and that drags down the return in your overall portfolio.
Yeah, and I've done the math on that before, right? If you look at your retirement account, say over a couple decades, if you have stretches in there where it's earning 0, that makes a massive difference by the time you get to the end, because now those gains you would have had aren't compounding out in the future years.
Yeah, exactly. So with the book, I really spend a lot of time talking about the power of self-directed retirement accounts, right? Whether it's a traditional IRA or Roth IRA, as well as health savings accounts, which are, in my opinion, not utilized enough. People don't know how they work, and how to properly utilize them. It's such a powerful tool. I mean, HSAs, they're a hybrid, really, between the traditional IRA and the Roth IRA. And here's why, right? With the traditional IRA, you have a tax deduction for your contribution, right? Mm-hmm. You have a tax deduction on your contribution, right? But then you grow the account through your investing. And then when you withdraw, now you have to pay taxes at the end.
Right.
But with a Roth IRA, the big benefit there is you're paying your taxes up front, then you grow the money, and then at the end, when you withdraw, that becomes tax-free. So it comes down to you pay your taxes up front or in the future. And I know one thing's for sure. With the way things are going in our economy and government and what they've been doing, I have a pretty good feeling that taxes are going to be a lot more in the future than they are today. So I would rather pay them at today's lower rates than potentially higher rates in the future.
Right. Because, at some point they're almost going to have to go up. I mean, chickens are going to have to come home to roost. So let's take that and the whole idea there. Here's a great analogy. I love this analogy. It's the farming analogy, the agriculture, right? Would you rather pay tax on the seed, or would you rather pay tax on the harvest after you've done all the work? And that really explains Roth IRAs in a nutshell. So let's get back to HSAs, health savings accounts. The unique thing with those accounts is that your contribution is a tax deduction, right? Mm-hmm.
But then you grow the account tax-free. And then at the end, when you withdraw, as long as you're reimbursing yourself for qualified medical expenses, that's tax-free as well, which is so powerful because you get the tax deduction going in, and then coming out, it can be tax-free as well, which is amazing. Amazing. So I always encourage people when I talk to them, I mean, look into that. It's a more complex strategy, but if it makes sense for you, definitely talk to your CPA, talk to your advisors, and learn how to leverage the power of HSAs. And any custodian like your self-directed IRA custodians, they all can handle HSAs, and you can self-direct. So this allows you to invest in what you know, in those alternative assets like real estate or notes or any alternative assets. You can do that through an HSA. So that's another thing that I really wanted to highlight that I cover in the book. I feel so strongly about this, and so I encourage folks, look into that.
Yeah, that's interesting because I've always seen the self-directed HSA as like an option, but I've never actually delved into it to look at doing it. I've got my self-directed IRA, but that's been it on the self-directed side. So what that was, or go ahead. Sorry, I thought you had something.
No, go ahead.
Oh, I was just going to ask, as we get into the new year, so where do you kind of see the note industry heading, and how do you think things are going to be relative to kind of what we saw in 2020?
It's funny. There's what I'm seeing is a lot of movement. I'm definitely seeing assets being sold to create liquidity, which creates opportunities for sure. I'm also seeing a lot of people, or a lot of instances where people have gotten scared because of the pandemic or the current environment and backed out of note transactions at the last minute. Like
these more like individuals or bigger?
Both. Individuals, funds, like larger size transactions where there's a contract that's not getting executed on. And this happened to me. This happened to me multiple times this year, where I got a phone call that there was a transaction that someone backed out, or an entity backed out, and I got the phone call, "Hey, are you interested to jump in? We know you're liquid. Do you want to jump in here?" And it was a good opportunity, so we quickly were able to assess that opportunity, do our due diligence, and jump in. And let me tell you, it feels really good to get those phone calls. That all is based on your reputation as a note investor, your reputation in the industry. I mean, as you know, the note investing industry, it's a small world, and we all know each other, right? We go to conferences, we talk to each other, everyone knows each other. So it's a small world, and it's great. It's great to have opportunities come to you that way.
Yeah, and when you're reliable, they will, right? Because so many people, especially more on the individual basis, are tend to be kind of flaky. So if you have a reputation as someone who has a defined model, and the seller knows that, okay, if it fits Fred's model and the pricing's right, they're going to be able to close. Yeah, that's really nice. That's where you see a lot more things come your way. Because I've seen a little bit of that flakiness too, where a lot of the investors the past year have just been kind of scared with what's going on, and so I've observed this sort of. I really saw this kind of change at the end of 2020, but for the most part of the past year, it seemed like there were the buyers were just kind of scared, and so they were cranking their pricing low, and then a lot of the sellers were like, well, the underlying real estate values have been soaring and they've kind of moved their pricing up, and there's been this sort of, mismatch where there hasn't been quite as much trading as you would expect to see, but that, appears to be kind of loosening up and shifting.
Yeah, absolutely. I mean, I'm seeing opportunities pop up in the secondary market. And as long as if you're aligned with a fund manager where they're uniquely positioned, they're able to add more value, that ultimately creates more upside for the investors, which can be really powerful. So some other things I'm seeing in the note industry, definitely we're seeing an increase in regulation from government entities, state and local. That is heading on an upward trend. So you want to be staying abreast of those changes. The environment changes constantly. Mm-hmm. So you want to be paying attention to that in the regions where you're investing, right? There's so many of these nuances, jurisdictional nuances, I call them, where you have to pay attention and watch that, because regulation in the note industry and in the business environment in general, it's definitely going to be increasing for sure. More regulation, more government oversight involvement. So you need to be positioned appropriately for that.
Yeah. And I found too, like I always went in this assuming like the rules would always be black and white. Sometimes it's not even that regulation changed, but like an official, like an interpretation changed of what was already
exactly
there. So sometimes the rules are like fuzzy and gray and not black and white, which makes it a little bit of a challenge. Because my attitude is like, if you just tell me the rules, I can play by them. But I hate those scenarios where it's like, well, it could be this, could be that. You're probably good, but they may come back later and question you. Yeah.
Yeah. So the one thing that you can be certain of is there will always be change, right? We're coming into an era where there's going to be change for sure due to the new presidential administration, which is coming in. They're going to be making changes in this area of business regulation. And some of those changes will be positive for small business owners and entrepreneurs, and others won't be. So you need to pay attention to what's going on. You need to align yourself with good advisors, a good team to help you, guide you and navigate those waters of uncertainty.
Yeah, absolutely. So, well, that's good. Well, it sounds like you're pretty well set up for the rest of the year. And yeah, it was very exciting to have a book come out. I know how much work those are. I wrote a poker book about 11, 12 years ago. And it was, people who haven't done it don't realize how much goes into creating those. So
it is. It's a lot of work, but for me, it's been a labor of love. It really has. It's been such an opportunity for me to connect with a wider audience, share some of my ideas and concepts with a larger, broader audience. And I talk to investors all the time. And people are looking for guidance. They're looking for experts to follow, to align themselves with. And this has been such a wonderful project for me. But you're right. It's a lot of work. And I'm not talking just about the writing part of it. That's one piece of it, which is a lot of work in itself. And writing a book is definitely a long slog. It really is. And sometimes you get unmotivated and you just have to push yourself to keep going, make incremental progress. That's the best way to approach it. But then when the day comes where your manuscript is done and then you have to get the book produced and published, which is a lot of work in itself as well. Something I underestimated how long that was going to take. But I'm happy that it's at the end. It's finally launching now. So I'm really excited. I can't wait to see the outcome of that, and to touch other people's lives, get them thinking about new ideas, getting them exposed to new opportunities.
No, that's awesome. Well, yeah, and then I will, there's obviously the audio part, but on YouTube and on the blog, I'll add links, to where everybody can find that. But yeah, I'm looking forward to checking it out myself. I haven't gotten my hands on it yet. So cool. Well, Fred, thanks so much. Really appreciate having you on again. We'll probably do it again next year. Maybe we'll just make that maybe we'll just schedule that in like once a year or so.
I love that. Idea. January is a great time to really to assess your business, assess what you're doing, think about things you want to achieve in the upcoming year. And most importantly, look back at the previous year and acknowledge all of your wins, right? I think it's so easy for all of us to lose sight of that. We get so busy and wrapped up, but that last week of the year, take some time, get in some serious thinking time under your belt, and just go back month by month and write it down, make a list. It's easy to make a list of the top 20 or 30 things, great things that have happened to you in the past year. And if you go through it one month by month and look at that and just take a moment to acknowledge the new relationships you've built, acknowledge the wins, the achievements, the growth, and the development. Just take a moment to really take that in and celebrate that. I think that's so important. And that helps you to build momentum moving forward into the new year.
Yeah, because sometimes you get so busy with the day-to-day, you almost forget a lot of the good things that happened, or, some of the successes you've had. So awesome. Well, Fred, thanks so much, man. Really appreciate having you on.
Thank you so much, Dan. It's been a pleasure coming back on your program again. And if anyone is interested to connect with me or reach me, can visit my website, fredmoskowitz.com, and select the button to connect with me. Thank you.
All right. Thank you.